Microsoft just crushed earnings by $1 billion. Revenue came in at $81.3 billion versus analyst expectations of $80.3 billion. Earnings per share hit 4.14, beating the 3.91 expected. Azure, their cloud business, grew 39% year over year, and yet the stock dropped 12% in a single day, wiping out $350 billion in market cap. That's more than the entire value of Netflix, gone in just 6.5 hours of trading. So here's the question that should keep you up at night. How do you win and still lose? I'm going to explain what Microsoft's earnings beat turned into a bloodbath and what it tells us about the AI infrastructure race, because this isn't just Microsoft. This is about how markets price future expectations versus present reality, and why the companies spending the most right now might face the harshest corrections later. Imagine you're at a high-stakes poker table. You've been raising aggressively all night. Everyone knows you have a strong hand because you keep pushing the pot. Finally, you flip your cards. A full house, kings over tens. That's a winning hand in almost any scenario. But here's what happens next. Everyone else looks at your cards, nods, and cashes out. They leave because, sure, you have a strong hand tonight, but you've been betting so much that your future hands need to be even better just to break even on what you've already committed, and they're not sure you can pull that off. That's Microsoft on January 29th, 2026. Let's break down the earnings report because the devil is in the details. CNBC won't cover in 3 minutes. Microsoft reported $81.3 billion in revenue for the October to December quarter, up 17% year over year. Their intelligent cloud segment, which includes Azure, hit $32.9 billion, up 29%. Azure itself grew 39%. On paper, these are incredible numbers. Most companies would be thrilled. Analysts expected $80.3 billion. Microsoft beat by $1 billion. Good news, right? Here's the catch. Azure grew 39%. Sounds amazing until you look at the previous quarter, 42% growth, and the quarter before that, 31%. The growth rate is decelerating. Now, 39% growth for a multi-billion-dollar business is still incredible. You're not wrong, but markets don't price last quarter, they price the next 12. And when you're Microsoft trading at a PE of 30, the market expects acceleration, not deceleration. During the earnings call, Satya Nadella said demand for Azure AI services is strong. Then came the kicker. Capacity constraints will continue through the end of the fiscal year, June 2026. Translation: they could sell more, but they can't build data centers fast enough. Sold out business might sound good, but for investors, it's a warning. 39% growth could be the ceiling, not the floor. Markets hate uncertainty about upside potential. Now let's talk about the number that really spooked investors. Capital expenditures. Microsoft spent $37.5 billion on CapEx this fiscal year, up 66% from last year. To put that in perspective, Microsoft's total revenue in 2010 was $62 billion. They're spending more than half of that in 1 year just to build AI infrastructure. Here's why that matters. CapEx doesn't hit the income statement like regular expenses. It's capitalized and depreciated over time. So, while Microsoft can show strong earnings, free cash flow is being hammered, and free cash flow is what smart investors care about. Operating cash flow last quarter was $28.7 billion, but CapEx was $11.4 billion. That's 30% of cash flow going straight into infrastructure before anything can return to shareholders. If CapEx keeps growing faster than revenue, the math becomes a problem. Sure, this investment might pay off eventually, but markets are probabilistic. Microsoft is betting billions on AI infrastructure, hoping the returns justify the capital deployed. The problem? No one knows if that will happen. Contrast this with Amazon in the early 2000s. AWS was creating a brand new market. Every dollar spent opened new revenue streams. Today, Microsoft is mostly fighting for market share in an already crowded AI services market against Google, Amazon, and well-funded startups. It's not a greenfield, it's trench warfare. And here's the kicker. AI infrastructure economics might be worse than traditional cloud. Selling compute hours on Azure for regular workloads yields 60 to 70% gross margins. AI workloads, you burn through $30,000 NVIDIA H100 GPS in months, not years. Margins could drop 20 to 30 points. Picture this. You're a portfolio manager running a $400 million tech fund. You own 2 million shares of Microsoft at $400 each. That's $800 million. An oversized position. Earnings come out. Revenue beats by $1 billion. Azure deceleration, capacity constraints, CapEx up 66%. You have 90 seconds to act before after-hours trading reacts. Microsoft is priced for acceleration. Deceleration and exploding CapEx compress the multiple. If PE drops from 30 to 27, that's $80 million lost. So you sell. Others do the same. That's how $350 billion disappears in a single day, even on an earnings beat. This isn't unique to Microsoft. Google, Amazon, Meta, anyone betting billions on AI infrastructure is playing the same game. Spend now, hope for returns later, pray for patience. Markets, however, have zero patience when Treasury bills yield 4.5%. Consider incentives. Nadella's pay is tied to revenue growth and stock performance. The board wants Microsoft to remain a $2 to $3 trillion company. Institutional investors demand growth to justify valuation. The result? Massive spending to maintain perception, not necessarily economic efficiency. The reality? CapEx is defensive. Microsoft isn't spending $37 billion because ROI is guaranteed. They're spending to protect market share. Arms races destroy returns, even if you win. The big takeaway? Earnings beats don't matter if growth slows. Microsoft beat revenue by $1 billion, but Azure deceleration and CapEx spikes wiped out gains. Markets price acceleration, not just absolute growth. Capital expenditures matter more than reported earnings when valuing businesses. Free cash flow tells the truth. And when mega cap tech is priced for perfection, minor disappointments trigger massive multiple compression. If you own Microsoft or any big tech betting on AI, ask yourself, do fundamentals justify the valuation, or are you just afraid of missing out? Two very different theses. One survives days like January the 29th, 2026. The other gets crushed. Here's the lesson. Microsoft isn't a bad company. Azure is profitable. Satya Nadella is competent. But the stock may be dead money while the business grows into the valuation. Valuation always matters eventually. Maybe not today, maybe not this quarter, but eventually, price converges with value. And when it does, the adjustment is brutal. Stop confusing a good company with a good stock.